In this tutorial, we're looking at income, and in particular, we're looking at how to go about structuring a question, actually answering questions about income tax. And so note here, the first question from your tutorial this week is broken up into 5 parts, where we're looking at 5 different types of receipts that an Australian taxpayer is having. We've got damages from personal injury as compensation, we've got compensation for loss of income, we've got honorarium or fee paid to the Secretary of an association, tips received as part of hospitality occupation, and a lotto prize of $1 million. We'll look through each of those now. So the first thing I think it's worth noting is the style. Now this is a complete answer for something you'd expect to be worth sort of 4 or 5 marks in a test or an exam. But what I really want to draw emphasis to is this IRAC or IPAC method. It's basically a way for structuring professional advice that you're giving, both in business and in law. The IRAC method starts with identifying the particular problem that your client has, in our case in relation to law, the legal problem, then explaining all of the appropriate rules or principles that you're going to need in order to actually answer that particular question. And after you've explained all of those rules and principles, everything that the reader needs to know about the law in this area, then taking that legal knowledge and applying it directly to the facts. And finally, after we've done that application step, we make a conclusion. We give the actual information needed by the client back to them in very simple form. So there's some things that I want to explain about using the IRAC method that both business and law students ought to be familiar with by the stage in your education. Firstly is that it looks quite hideous. You really don't need to have the words issue, rules, principles, application, conclusion, and so on. That's the first thing. That if you were actually presenting information to a client, you just simply wouldn't use these words. In fact, what you would do with a question like this is simply to take the issue itself, and I do recommend for this strategy in exams that the issue itself forms a question. Underneath that question is the appropriate rules and principles. So we've got the issue, the appropriate rules and principles, then leave a line and start the next section with something like here, or in this taxpayer's case, or in Alfred's case, or whatever the name of your client is, and start applying the law at this particular point. And the conclusion is something that usually ties together multiple questions that you've been answering. The idea is that the client, at the end of the day, doesn't really need to know all of the details. They need to know the result. How much are they going to get sued for? How much can they deduct in this particular account? How long are they going to go to prison for? And so as a result, the IPAC and IRAC method itself in practice needs to be adapted to suit the particular circumstances that you're using it in. Now, if this style of question formed an exam question and it had 5 parts, it would be completely appropriate to answer each of them with by phrasing it as a question in this way. And the conclusion would come at the end of each of the questions you're answering, and just explaining what happens in each case. In this case here, assuming there's no further information to apportion these damages, the amount's not part of assessable income. The next very common question that I get asked while teaching law subjects is, do we need to include citations? And the answer to that, certainly for this subject, is yes. To put it simply, every rule or principle that you're stating or asserting has got to come from somewhere. Every law that we have and that we obey in our society has to be written down somewhere, either in the common law that made up for judges or in statute. Now, one of sort of outcries that we often face from that is particularly in exams, needing to have the quality of citations there. Now, in an exam situation, really what you need to do is to be able to demonstrate the source of the rule or principle that you have. So an example here from the very first sentence on the screen is Meeks's case. A common law compensation takes the same character as what it's replacing, and that's just simply Meeks's case. In the exam, in brackets, Meeks, if you were doing your take-home test where you want to have quality of citations, then you would do that in full. And in the series of tutorials, where possible, I've included the citations, the full citations. You'll note, and this is relevant to those that have studied a bit of law and had to use the Australian Guide to Legal Citations, that tax reports and tax cases have slightly unusual citations, so that you'll see something like Tinkler here, for example. Tinkler and the Federal Commissioner of Taxation, 1979 Australian tax cases, and then the case number 4641. You'll note in these tutorials I'll use FCT exclusively to refer to the Commissioner, and I reduce the case names as much as possible in order to convey the parties. You may also note, and again those that have studied law before may recall this from using the IPAC and IRAC method, that when explaining the legal rules and principles, these are agnostic to the facts. In other words, there's no mention of our particular taxpayer when describing these rules and principles. And in the application step, when taking this and applying those principles to the facts, we don't introduce any new rules or principles. In that way, you can really, I guess, build up your notes and your the materials that you're producing throughout the semester in order to be able to take them into the exam with you. I mean, one of the things that I've said, a little tongue-in-cheek, is that this law is not going to change between now and the day you sit your final exam. Therefore, the rules and principles that you state when answering your tutorial problems and questions, and the way you state it and the citations you use, you can take that straight into your exam. In other words, you are essentially beginning your exam prep now through putting the time and effort into building structured, high-quality tutorial answers. So now, looking at the subject matter, here we're looking at this really important distinction between replacing, I guess, a capital asset, being one's body when we get injured, or compensating for loss of current and future income. Now, the analogy here is that our bodies and our ability, our capacity to earn income is the tree, and that's a capital thing, whereas the product of our labour and our time, that's the fruit. So that's where this analogy of the fruit and the tree, and as Business Cat succinctly states, when dealing with income tax, the tree and being compensated for the tree is in many ways is a good thing. These days it's subject to capital gains tax, but that's significantly diminished, particularly for individuals with a 50% discount. And so in most circumstances, the taxpayer is seeking to have things deemed to be on capital account as opposed to on income, where they have to pay, and in particular when a lump sum amount of income, they may in some situations have to pay a lot in the same tax period, which can push people into high marginal rates. And so this explanation of the fruit and the tree, it actually predates Meeks's case, but that's in Australian law the foundational source for that idea that compensation takes the character of the thing that it is replacing, where it replaces present or future income. That's Tinkler's case, that's the fruit. And instead, if it's to compensate your loss of earning capacity, damage to your body, somehow stopping you from being able to earn, then that's capital in nature. And before 1985, that was essentially tax-free, before capital gains tax was introduced. Now, the interesting thing to note here is this apportionment. The courts are actually quite lenient in this area. So basically, if the amount that is given to a person can be clearly delineated, as in some fraction of it is to compensate for present and future earnings and or entitlements, and another fraction is clearly to compensate for the loss of earning capacity, the courts will apportion it to that, to those amounts. But they're even slightly more generous than that. In fact, if it can't be determined how this percentage is to be worked, then the courts are actually quite lenient in terms of deeming the entire lot to be on capital account. Now here, we're not given much information. It's just a lump sum damages awarded as compensation for a motor vehicle. We've got no information about apportionment, and as a result, arguably, if one was to give an answer, you'd argue that this doesn't form part of assessable income, but it would go in capital account. Now, if you were to get 2 questions like this in the final exam, it is quite acceptable to just make note when describing the rules and principles under the second question. Hey, look, just look at a PowerPoint. We've explained Meeks' case, Tinkler and Slavin, and so on. And so here the application part's the main bit. Now, it's also quite straightforward. When we're talking about the fruit and the tree, the previous question was referring to the tree. This part is referring to the fruit. Hey, when you get workers' compensation, those payments are really replacing your income, either your current, your present, or your future income and income streams. It takes the same character of that and is replacing those earnings. It's expressed to be compensating in this way, and it does form part of assessable income. It is 6-5 income. So in the next sub-question we're looking at honorariums. Those are payments made usually in incorporated associations to people that basically run them, that are on the committee. And there's really 3 ways that you can go about characterizing these. You can first think of them as being just a payment for service. In other words, hey, look, here's a service a person's doing, here's some money to pay for that. You can also look at it as a reimbursement if there are expenses that in this case the secretary has somehow incurred. And finally, you can try to characterize it as a gift. Now, payment for service is just straightforward, ordinary income. Look, we've done some service, this payment is in relation to that, that's income. If, however, it's a reimbursement of expenses, then it might not be. In other words, now note here that I've actually cited the Fringe Benefit Tax Act and Division 20-A of the 97 Act. Now, in this situation, the person's receiving an honorarium, so they're not actually an employee in this situation, but where an employee is incurring some expenses and the employer is reimbursing these, that is not ordinary income. And in that situation, particularly where the employer is able to deduct the things that they're compensating the employee for, that's what's known as a recoupment or a reimbursement in the FBT definition. And we'll note that while gifts are actually they don't fall part of ordinary income, they're not ordinary income, they can be statutory income. In other words, Division 15, so Section 15-2 of the 97 Act will deem a benefit, allowance or gratuity provided to the taxpayer and that really relates to the services that they've done. That is deemed to be statutory income. However, if there's no connection between the gift and the service, then it's a simple gift, it's a windfall gain, and that's not taxable. So here, when we're looking at the honorarium relating to the secretary, it's very likely here that it's for services rendered. Look, they've done something, I've been a good secretary on this organisation, and the board has deemed it appropriate and to compensate that person in that way. There's a clear connection between their effort, their personal exertion, and receiving this sum of money. And so as such, it's arguably the services rendered and is going to form part of assessable income. The next item that we'll look at is quite a common occurrence in terms of receiving money, and that's tips for those that work in hospitality and similar industries where a person is performing service and other people, I guess maybe it's a cultural thing to reward people ad hoc. That is just, in Australia, is just straightforward ordinary income. There's a clear connection between the service and the receipt of money. And now, even if the person giving it was to characterise it as some form of gift, that doesn't really matter, because it can still be deemed to fall under the statutory income, and again in 15-2 of the 97 Tax Act. And so really here it's going to form part of assessable income, and it can either be under ordinary income under 6-5 or a statutory income under 6-10. Now the fifth and final simple receipt that we'll look at is everyone's favourite form of income, and that's winning the $1 million in the lotto. And the question there is, will that form part of assessable income? And the answer is no. It's what's known as a windfall gain. So gifts are usually deemed to be windfall gains unless there's some connection between an income producing activity. Now with something like lotto, look, in theory you could have some form of syndicate that buys lotto tickets in order to somehow beat the system. It's theoretically possible, but very, very, very unlikely that the Commissioner would accept that even very, very heavy, I guess one can say, consumers of lotto would be deemed to be in the business of doing that. However, there are people who are in the business of gambling, and I draw your attentions to Mr. Evans and the FCT. They're the taxpayer. Was really, really good at gambling and made a stack load of money, and so the Commissioner there is trying to say, well, really, hey, you've made a whole bunch of money. These aren't windfall gains. You're in the business of doing that. Now, we look later in this subject at the nature of being in the business of doing things, but really it's all about reliance, periodicity, whether or not there are a lot of systems in place, and the entire purpose of the endeavour is to make a profit. And if a person was in the business, then it would simply be ordinary income. And so here I guess the answer, the solution to this is quite straightforward, that windfall gains don't form part of assessable income. The next part of this tutorial involves us looking at exempt taxpayers and exempt receipts. And so I guess explaining these is actually quite straightforward. Exempt taxpayers simply don't pay any tax. Whereas exempt income, when it's received by people who do pay tax, such as all natural persons, then that income itself, there's no tax payable on that. It's not assessable by the Commissioner. And so the first part of this question we're looking at is actually quite tricky. Whether dividends received by a university from shares that were bequeathed to it, and where those shares were bequeathed for a specific purpose, that is to provide for education, would that be exempt? And then also asking after that, what about the shares themselves, assuming they get disposed? And the answer is pretty simple. Public educational institutions like universities are just simply exempt entities. The relevant sections there are 11-5, 50-5, and it's somewhere in that table in item 1.4. And so JCU, it's an exempt entity, it's not liable for tax. And there's no CGT liability either. The CGT, at the end of the day, is when you make a capital gain, upon disposal, it's added to your income in that particular year, and if you're an exempt entity, it doesn't matter, because you're not paying tax either way. So perhaps a slightly trickier question is looking at money that comes from the Army Reserves. And again, this is all governed by statute. Erica, in this case, is not an exempt entity. And so we're just really trying to look to see whether the amount itself is exempt. And delving through the 97 Tax Act in 55-5 and item 1.4, it turns out that Army Reserve Force members that are paid but not in full-time service receive that payment as exempt income, and she's not liable for tax on it. So for the next part of this tutorial, we're looking at some specific types of receipts and assessable income scenarios. We're looking at holidays, things that are given to employees and non-employee agents as part of it, and a few things to do with property and income relating to property. Now, the style that I've used here is how I would go about answering questions like these in short answers. Now, for those that are familiar with previous exams for the subject will know that in one question in previous year exams is devoted to short answer questions that are worth simply 1 mark each in the exam. Now, where you've been given a question and it's worth only 1 mark, it's quite inappropriate to use the IRAC method for answering that. What you want to do is to be able to explain the particular rule or to answer the particular question really in as few words as possible, and so that it's perfectly acceptable in that situation to explain what's going to happen to the taxpayer and then cite the particular case citation, or to at least explain the rule in maybe a sentence or two. And often the answers are very, very simple. Here, for example, in the olden days, this non-cash benefit that was given, the Commissioner would have really tried to make these things to be deemed to be relating to employment, and there are provisions in the 36 Act for converting a non-cash benefit into the equivalent cash value. Here, though, it's really simple. It's a fringe benefit, so that the employee receives the benefit, does not pay tax on it. That's section 23 capital L sub 1, and the employer will pay fringe benefit tax at the in other words, the amount the employer would have to pay here would be something like $9,000 because it's the gross up value. Now, the next of these short answer questions is to do with the exact same scenario, but when you've got a contractor, a person who's not an actual employee, and as discussed in the lecture, non-employee agents, because they're not employees, they don't get fringe benefits. This is the Cook and Sheridan, the Toowoomba soft drink seller case. And section 21 capital A of the 1936 Act just deems that to be a non-cash benefit, and the amount that is added to the taxpayer's income is just equal to the amount, the value of the holiday. And the next part of the question was looking at rent. Now, rent is quite simple. It's just ordinary income. It's income from property, and it falls under that definition, and it's assessable as ordinary income. Where things get trickier is with that part D, where we're looking at board receipts by parents of a 16-year-old. Now, leaving aside any sort of evidential difficulties with that, by and large, this is going to be deemed to be a simple reimbursement of household expenses. It's $100 a week, and again, the course will look at this, is that an appropriate or fair market value? But by and large, if it's a small amount or a token amount, it's really going to be deemed to be a reimbursement, and it's not going to be income. There are some situations where it might be, and those situations are where the house is run like a boarding house, and the 16-year-old is paying something equivalent or close to what other boarders might be paying in that environment. And so the description there is that they will examine the character of that receipt in the hands of the recipient, the person receiving it. Is it something that, from their perspective, is to just reimburse expenses from having this room, or is it something that really takes on the character of income itself? So I hope that this material is useful and that you guys can use it in order to create good structured model answers yourselves.